Could I ask everyone to take their seats? We're going to get started in just a couple seconds. Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's our pleasure today to host a speech and a conversation on the economic outlook and monetary policy with the Honorable Adriana Kugler, who is, of course, a governor of the Federal Reserve Board. We're going to get right into substance in a moment. I just want to congratulate Dr. Kugler that she is now, I guess, wow, it's longer than I thought. I guess it's more like 7, 8 months in, 9, 10, okay. As a member of the Board of Governors, we're all spoiled that there's now a full set of 7 members of the Board of Governors, something that wasn't taken for granted for a long time. And she is filling an unexpired term ending in January 2026, although of course is available for reappointment officially. Prior to her appointment at the board, Dr. Kugler served as the U.S. Executive Director at the World Bank Group. She's on leave from Georgetown University, where she was a professor, or is a professor of public policy and economics, and had the thankless job of being vice provost for faculty, which I do not envy. Previously in public service, she served as chief economist at the U.S. Department of Labor from 2011 to 2013. She's been a research associate of the NBER and of the Center for the Study of Poverty and Inequality at Stanford. She's been chair of the Business and Economic Statistics section of the American Statistical Association and on various appointed task forces of the National Academy of Sciences and the Technical Advisory Committee of the Bureau of Labor Statistics. So we welcome and appreciate economics nerds in this building as few other places do, but I don't mean to be dismissive. As a public servant and as a scholar and now as a policymaker, Dr. Kugler has had an already important influence on the course of monetary policy and how we think about labor markets and the economic outlook in the US. And with that, I welcome her to the Peterson Institute stage.
Well, thank you so much, Adam, for that generous introduction, and thank you for inviting me to speak here today. It is really a great honor to come to Peterson to discuss the economic outlook and monetary policy, which will be my topic this afternoon. As I stand here today, inflation remains too high, but I'm certainly encouraged by the overall progress and the trajectory that we have been seeing. Recent data on the economy and inflation also gives me cautious optimism that we're on track and making good headway towards the Federal Open Market Committee's inflation goal of 2%. That progress may have paused for the first 3 months of the year, but information since then on economic activity, on the labor market, and also on inflation definitely point towards renewed progress. Over the last year through April, personal consumption expenditures, or PCE inflation, was 2.7%, down from 7.1% at its peak in the middle of 2022. Core PCE inflation, which excludes the volatile food and energy categories, as you well know, was 2.8% through April, down from its peak of 5.6% at the beginning of 2022. Based on consumer and producer price inflation in May, which as you know was released last week, I estimate that 12-month PCE inflation in May was a bit lower than in April. I was encouraged by some of the details in the recent report, particularly the continued improvement in market-based services inflation, which is based on actual observations of market prices rather than imputed values for services, like in the non-market prices category. That's actually important because market-based prices are likely to be a better indicator of the overall trend for core services inflation than these non-market prices. Housing services inflation, on the other hand, continues to be persistent, Market rents for new tenant leases have already cooled significantly, but further progress in overall housing services inflation will certainly have to rely on ongoing pass-through of prior rents decelerations onto new tenants who are either renewing their leases or getting new leases. So inflation is still too high, and further progress is likely to be gradual. However, there are several reasons why I remain optimistic that improving supply and cooling demand will support continued disinflation. The first reason I am optimistic about further progress on inflation has to do with declining price increases and even declining prices as consumers become more price sensitive. I think of these from several unrelated angles, and I will mention just a few. As I have mentioned in previous speeches, reduced frequency of price adjustments helps to moderate prices, and the frequency with which firms adjust prices, which accelerated to less than 5 months in early 2022, moved closer to every 7 months as of the end of 2023. Price adjustment frequency picked up some at the beginning of the year, certainly with this temporary firming on inflation that we saw at the beginning of the year, but the general trend has been consistent with ongoing disinflation. An additional reason for price-setting optimism is the fact that longer-run inflation expectations have remained well anchored. Research by the Richmond Fed has found that price-setting decisions by firms are closely related to their own expectations of the path of overall inflation. So anchored inflation expectations among firms are likely to result in price setting consistent with those lower price expectations. In addition, there may still be room for markups of prices over labor costs to continue to fall. While markups are famously difficult to measure, for those of you who have done measurement of markups, some rough and simple estimates of markups of prices over labor costs show that they have fallen from their very high levels, but it still remain above pre-pandemic trends. This means that there is still room, and if we are able to return to that trend, we may still see some progress, additional progress, towards our 2% inflation target. A final reason for optimism, and I pay attention to both quantitative and qualitative data that is incoming all the time. A final reason for optimism about price-setting developments is the range of anecdotes from firms themselves. The most recent edition of the Fed's Page Book suggests firms are increasingly attentive to consumers pushing back against additional price increases, and that these businesses expect to increase prices only moderately in the near term. Beyond the Beige Book, I have gleaned over recent earnings reports by publicly traded companies that lower-income consumers are pulling back from their purchasing, and that firms are responding by moderating price increases, and in some cases, even cutting prices. What I have heard in my own conversations with various contacts is that consumers are trading down to lower cost products, and that firms are responding to this by giving discounts. And some large retailers have publicly spoken about cutting prices in the face of resistant consumers. These various indicators, including price adjustment frequency, inflation expectations, markups, and also anecdotes from a range of sources, suggest on balance that price-setting behavior is likely to continue to move us closer to consistency with our inflation target. A second factor for my optimism about continued disinflation is a slower growth in the costs faced by businesses. Among those, nominal wages are a big part of total costs, especially in the services sector. Nominal wage growth has continued to trend down, consistent with a labor market where supply and demand are really coming into much better balance. Of course, as a general matter, I want to see Americans experiencing a strong wage growth, but for that wage growth to be sustainable, it must be consistent with our inflation target. Notably, as inflation has come down, real wages have been rising and now exceed pre-pandemic levels, which means that the purchasing power of workers has also been increasing. But at the same time, we have seen a slowing growth in nominal labor costs. For example, the 12-month increase in average hourly earnings has been running just above 4% over the last couple of months after peaking at around 6% in 2022. And we have seen this falling steadily over the past few years. The latest readings compare with an average of around 3% a year before the pandemic, when inflation was running below our 2% target. So this wage moderation is particularly evident in some of the services sectors in which labor is a large share of costs, and so it is particularly important in the services sector. If this moderation in wages continues, it will soon be at the levels consistent with price stability. And I note that the market-based services inflation measure that I mentioned before actually moves closely with wage growth as well. Other developments in the labor market also point towards continued resilience, but there are signs of gradual cooling and continued wage moderation. Gains in payrolls averaged 218,000 over the past 2 months, which is certainly a solid pace. But most other indicators point towards a slower but steady easing of the labor market, supported by cooling demand, but also by a strengthened supply. In terms of demand, both the job openings rate and the hiring rate have come down from their highs in the late 2021 and early 2022 years. The job opening rate is not far above its pre-pandemic range, and the hiring rate is actually below the pre-pandemic rate. Surveys of business hiring intentions from NFIB and other sources suggest cooler demand for workers. On the supply side, we have seen notable growth in labor supply over the last year. Labor force participation among prime-age women in particular reached yet another record high in May. And the strong inflows of immigrants I have discussed in prior speeches have continued this year, which points to continued labor supply growth as recent immigrants gradually make their way into the labor force. With cooling demand and solid supply, measures of labor market tightness have continued to ease. The unemployment rate has been gradually rising and reached 4% in May, which is still low by historical standards and is the 30th straight month at 4% or lower. Another indicator of labor market tightness, the ratio of job vacancies to the number of people counted as looking for work, crossed an important threshold in April. After rising as high as 2 vacancies for each person seeking a job during the pandemic, this ratio fell back to 1.2, which is the same level that we saw before the pandemic. Another indicator of labor market tightness, the rate of people voluntarily quitting their jobs, is actually also below pre-pandemic levels. The average duration for job vacancies is down, and it is becoming easier for employers to fill jobs. We, policymakers, make our judgments on the basis of preponderance of the data. And the preponderance of the labor market data indicate that the labor market and labor supply and labor demand are certainly coming into better balance. A third reason for my optimism about achieving 2% inflation is that I'm also cautiously optimistic about productivity growth, which is a source of supply expansion that is, again, likely to put downward pressure on inflation without actually slowing growth. One factor likely to contribute to the increase in productivity is the remarkable rise in the rate of new business creation, or the surge in startups that we have seen since early in the pandemic and which has continued even through the last month. Economic research finds that while many new and young firms struggle to survive, a subset of new firms are highly productive and grow rapidly, eventually making significant contributions to aggregate productivity, and I've contributed to that research myself. And the pandemic era business creation surge has been particularly strong in high-tech sectors, such as computer system designs and research and development services. Prior to the surge in productivity growth in the late 1990s to the early 2000s, there was in fact a very similar wave of strong business entry in high-tech industries. So this parallels that time period as well. I suspect that most of the productivity benefits of this recent surge are still ahead of us, but we might have started to see a little bit of that increase in productivity already. Another reason for productivity optimism is the prospect for widespread implementation of AI in its various forms. To be sure, there is tremendous uncertainty around the path of AI and its effects on the economy, and we must all think carefully about how it may affect workers and certainly the kinds of tasks they perform. But AI technology has the potential to make workers and firms more productively, effectively boosting aggregate supply. Of course, many technologies can take a long time to show up in aggregate productivity. The spread of electrification more than a century ago required complementary assets like power lines and appliances. But I actually suspect that AI may diffuse more quickly, in part because many of the complementary assets that are required for the initial spread of AI, such as computers, networks, and the like, have already taken place, even while, of course, there may be an enormous amount of additional hardware build-out is still ahead of us. And survey data from the Census Bureau suggests that firms in many sectors are already employing AI. Only time will tell, of course, but the prospect of higher productivity growth raises the possibility that inflation can fall without a significant slowdown in economic activity and employment. My final reason for optimism on inflation is that I believe the current stance of monetary policy is sufficiently restrictive to help cool the economy and bring inflation back towards a 2% target without a sharp contraction in economic activity or a significant deterioration of the labor market. Interest rates remain elevated relative to a year ago, and certainly relative to 2 or 3 years ago, and are restricting economic activity. Of course, some aspects of financial conditions, such as housing prices and stock prices, remain robust, and credit is still generally available, though high interest rates make borrowing expensive. This likely has some distributional implications. Higher income people with large stock portfolios may not feel that conditions are so restrictive. But if you talk to lower earners who need to borrow to buy a house or a car, you don't need to be told that their finances are tight. But the overall restrictiveness of financial conditions is apparent in interest rate-sensitive sectors. For example, the level of residential investment in the first quarter was still roughly 15% below its peak in 2021. Business investment in equipment contracted a bit in 2023 and actually showed only tepid growth in the first quarter of this year. And while consumption growth has been resilient so far over the last couple of years, we have seen definitely consumption growth continue, fueled by excess savings accumulated during the pandemic and solid real wages that now exceed pre-pandemic levels. Consumption growth actually slowed noticeably in the first quarter of the year, and especially for spending on goods. Indeed, high interest rates have left a mark on consumer assessment of buying conditions for motor vehicles and other large durable goods, which often have to be financed. The effect of restrictive financing conditions are also evident in labor markets. As I discussed earlier, the labor market has cooled gradually, and looking ahead, I expect some cooling of economic activity to continue. But I'm watching closely for other signs in labor market deterioration that may have taken hold, and so I am really paying very close attention to our other side of the mandate as well. Notwithstanding my optimism about the economic outlook, I am mindful of a number of risks to both sides of our dual mandate. On the inflation side, I took note of the resurgence of import prices at the beginning of the year, even if import prices came down some last month, as it could anticipate greater pressure on goods prices in the coming months. Goods prices have been a key source of disinflation over the past year, as supply chains have actually healed. While supply chains appear to have been fairly resilient to a series of shocks since the end of the last year, including attacks on shipping in the Red Sea, which continue, and lower water levels in the Panama Canal, which also continue, geopolitical developments in Ukraine and the Middle East still could lead up to a sharp rise in global energy and food prices and disrupt global supply chains. Another risk I'm focused on is further cooling on the economy on the other side of the mandate. I see the US economy as potentially cooling and creating a sharp deterioration in labor market conditions. So as I said, I'm paying a lot of attention to that. Output growth appears to have slowed in the first half of the year, and while consumer spending grew in the first quarter, the May retail sales report that we received this morning may be another signal that the long-expected deceleration in consumer spending may be finally coming. After a considerable decline in job vacancies, firms may be facing declining demand and they may have to resort now on layoffs as opposed to a reducing hiring. Lastly, I see risks to the global economy that could spill back to the US economy. While growth in some countries, notably in Europe, appears to have been picking up since the soft patch last year, that pickup remains somewhat tentative. And the latest data from China that we received just this weekend suggests that economic momentum there has slowed considerably given the continuing real estate crisis. Let me now turn to the implications for our economic outlook and for monetary policy. While I remain cautiously optimistic that inflation is coming down, it is still too high and moving down only slowly. I believe that policy has more work to do, which is why I supported the FOMC's decision last week to keep the federal funds rate in the range of 5.25% to 5.5%. We need to see more progress towards 2% inflation before I can be confident that inflation is moving sustainably towards that objective. For the reasons I have outlined today, I believe economic conditions are indeed moving in the right direction. If the economy evolves as I expect, it would become appropriate to begin easing policy sometime later this year. But as always, my judgment will be guided by the data. Let me conclude by acknowledging that the surge in inflation over the past few years means that prices are now significantly higher than they were just a few years ago. Even if the rate of price increases obviously has slowed dramatically since the mid-2022 period. While I'm heartened by the data showing that nominal wages are now growing at a faster rate than prices, I actually know that many Americans are still struggling with these high costs. I also know that many Americans are facing high borrowing costs. And that's why I am watching the data carefully as it comes in to consider both sides of our mandate and to make sure that we understand how it is affecting households and businesses. Thank you very much.
the step. Thank you. Thank you very much, Governor Kugler, and thank you for doing such a deep dive into how a somewhat data-dependent policymaker thinks, which is great for everyone to know. Given what you said and your background, of course, working at BLS, maybe we can go even a bit deeper on labor markets. So you mentioned the nominal wage growth trending down, and things coming back into balance. There are arguments out there. There was the SOM rule. There were various arguments raised about sort of stall speed. I'm not asking you to address any of those, but what are you watching for against the possibility of a sudden worsening of the labor market or missing a worsening of the labor market?
Yeah, thank you for that question, Adam. As I said in my speech, I really think there is substantial evidence of rebalancing. And this rebalancing has come from increased supply, mainly from prime-age workers and mainly women, but also from immigration, and a reduction in demand. And so far, this reduction in demand has come from a reduction in job vacancies and particularly a reduction in hiring. We haven't actually seen it come up as an increase in layoffs. So now this hiring rate is below pre-pandemic, which is why it is important to see if that continued reduced demand for labor is now going to be showing up as increased layoffs. So what do I look for? Well, JOLTS is a great source of data, but it's somewhat backward looking. So I try to look at real-time data. I try to look at UI initial claims. I look at warn notices. I look at reference of layoffs that come either in the beige book, in earnings reports, in Google searches. I look at surveys that are asking businesses what their anticipated layoffs may be, including ISM surveys or the surveys from Challenger, Gray, and Christmas. So there are a range of sources that we really can look at. As I said, so far, I think there has been a fair amount of rebalancing. I think there's still a fair amount of supply gains that we can see in terms of labor supply. But we're watching closely, definitely, to make sure that we're not surprised by a sudden increase in unemployment, because from previous experience, what we have seen is that when these phenomena take root, basically unemployment spirals up very, very quickly. So we have to be very cautious about it.
More broadly beyond the labor market, thank you for taking us through that. When you say that there are signs of policy being appropriately tight or credit conditions tightening, are there non-labor market indicators you follow to worry about the committee missing a turning point in the economy, or is the labor market the key indicator?
We look at the whole picture, not only labor markets, naturally. One indicator that we look at to look at the effect of our restrictiveness in terms of our policy is the FCIG, right, or Financial Conditions Impulse on Growth Index. That's an alternative to some that are produced by market participants. That particular index shows that we're still in restrictive territory, not as much as last year, but it's still in restrictive territory. It does allow us to see if, for example, this is coming from interest rates, if it's coming from exchange rates, which in this case is acting to be restrictive. But as I mentioned, equity prices, home prices are acting in the opposite direction. So far, we're still in restrictive territory because interest rates and exchange rates have a greater effect in terms of slowing down economic activity. And that slowdown comes in the labor market, but it also comes in the housing market. interest rate sensitive sectors, so the housing market and also business investment. So we have actually seen that type of slowdown coming through that end. In terms of consumption, as I mentioned, there has been a slowdown even the first quarter. So GDP numbers from the first quarter show that the contribution of personal consumption spending is lower to GDP growth in the first quarter. We have seen this coming out a little bit in retail sales. So that's another indication that things may be cooling in terms of economic activity. And another aspect that we're looking at very closely is how this affects specific households and businesses. So far, credit remains available even to small businesses, even if it has become much more expensive. On the household side, we have seen a really big increase in delinquencies. Delinquencies for credit cards, delinquencies for auto loans, for households. That indicates that households are being stretched in terms of their spending. They're increasing their balances and they're now facing delinquencies. So we look at the whole range of measures, as I mentioned, certainly not only labor market measures.
Thank you. Picking up on something you said, and which Peterson Institute's Karen Dinan featured in her April Global Economic Prospects presentation, is the seeming positive effect on the U.S. labor supply of increased immigration. Maybe you could talk a little bit more about how the increase in immigration affected labor market dynamics or inflation dynamics, really. And since there are obviously people thinking that more immigration means more displacement, how do you see the resilience of the labor market in the face of increased immigration? Because it looks like increased immigration didn't increase unemployment or anything like that.
So just taking a step back, if you remember during the pandemic, there was a huge withdrawal of workers from the labor force. And that meant also that net immigration went down. Basically, we have heard all the stories about the increasing tightness in the labor market, the difficulties hiring for businesses, the shortages that businesses were facing. There's still a little bit of that there. So if you look at measures, for example, from the quarterly survey of plant capacity, they give you the share of firms that claim they still face shortages, either in terms of labor and materials. There's still room there to improve. Past 2 years, right, moving forward, after that very drastic reduction in the labor force, we see people coming back in the labor force, prime age workers domestically coming into the labor force. And the CBO tells us that in the past 2 years, we had about 4 million immigrants come in. Those 4 million immigrants are trying and helping to fill many of those jobs that were unfilled. So that was a huge help on the labor supply side. Those workers are mainly in the services sector. So immigrants are overrepresented in construction, in leisure and hospitality, many of those services industries that were facing those drastic shortages. So that really helps. How does it help? It helps in 2 ways. It helps to increase productive capacity and to increase production and supply of goods in the economy and services as well. That reduces prices. And in addition, it allows for some wage moderation. It allows for wages to come down, which gets passed through to consumers as well, and it decreases prices. So it helps in 2 ways. And interestingly, this influx of immigration really helps us to understand that puzzle that we had seen over the past year or so, where everybody, I heard about the head scratchers in the FOMC and colleagues saying, this is such a puzzle, right? We're seeing a huge amount of economic activity together with this inflation. How is this possible? Well, immigration as a supply side push helps us to understand how it is possible to increase economic activity and at the same time to have seen last year a drastic reduction in inflation.
Thank you. I have to do the advertisement that a week from tomorrow, Wednesday, June 26th, we'll be holding here at Peterson a event on the effects of immigration restrictions, featuring Michael Clemens, Jonathan Portis, and Warwick McKibben, talking about some of these issues. Another way, Governor, that we can talk about getting out of the head scratching would be that there was a productivity gain, or gain in trend productivity growth in the US. And for most of calendar 2023 looked that way. And then the last couple quarters a little less so. You mentioned forward-looking, some hope for whether it's generative AI or other new technologies. Could you say a little bit about how we should interpret the positive productivity growth we've seen so far? Is that separate from or prelude to some of your optimism on productivity growth?
Yeah. So as you know, labor productivity is very volatile. It goes up and down. It had been down at 1.5% back a decade ago. It went really high in 2020. Naturally, not many workers around, so productivity was high. Then it went down again, and last year it went up to 2.6%. So, working through those ups and downs, where are we now? In the past few years, productivity is a little bit higher than what it was about 10 years ago, above the 1.5. I guess what gives me room for optimism is that I'm looking beyond labor productivity. I'm looking at the drivers of that labor productivity. And what we have seen in the past few years is that it's driven less by capital deepening and labor quality, and driven more by TFP. Mm-hmm. So that's where I kind of dive in and say, okay, what's behind this recent increase in productivity that we're seeing? And if it's just, movements in labor, then we may be a little bit more suspicious. But the fact that it's TFP driving that, and we expect that to be TFP moving forward, gives me hope that there may be an increase in productivity in possibly a more permanent way. Again, the fact that there was this surge in startups, which also predated the rise in productivity that we saw in the late 90s, early 2000s, yep. I think may be a prelude and may tell us something about what is to come. Again, there's a lot of uncertainty, but I think that may be playing in a few years. And as I said, I've done work in this area about reallocation and how new business entry affects productivity. There's a selection effect, but aside from the selection effect, these firms also grow faster. So that contributes to aggregate productivity. I think we may have started to see a little bit of that, but obviously the full effect has not been played out. So I think that's one factor. On AI, I'm a little more cautious, but again, I was surprised to see the census data, for example, that shows that the adoption of AI is already fairly broad-based. Mm-hmm. So 20% in information technologies, about 15% in sectors like professional services, but it's broad-based. There are about 15 other sectors where AI is already being used by about 5% of businesses. So it's already happening. I'm not saying it's already played out fully. As I said, some investments have already been made, which makes it easier to adopt than when we saw these productivity improvements in the late 1990s. But obviously, there will be more to come, and it's uncertain. And as I said, we have to be thoughtful about the impacts on workers and about, potential problems with adoption of AI and what we use it for. So I am cautiously optimistic, but I think there's a lot of uncertainty around AI.
Thank you. We'll be coming to the audience, our live in-person audience, for questions shortly. And just as is clear from the live stream, Governor Kugler has agreed to do all this on the record. Let me switch gears and ask you a sort of less forecast, more monetary policy question. A lot of us, myself included, toss around terms like R-star or neutral rate of interest, and at the same time we acknowledge you can't measure it, you can't taste it, you can't smell it. Do you find this a useful concept for policymaking in your discussions? I don't mean speaking for the committee, I just mean in your thinking. Do you find R-star a useful concept, and any thoughts on where R-star is now, if you do?
So I certainly pay attention to R-star. I think the R-star that most people pay attention to is long-term R-star, and that's the one that gets reported in the SCP,
Right.
The FOMC participants report. So this neutral rate of interest in the long run is some hypothetical concept about where the interest rate would be absent any shocks, absent any cyclical factors once you reach your 2% target. Basically, where this interest rate is neither stimulating nor restricting the economy. It is obviously important for us to try to understand that, but there is a whole lot of uncertainty behind measuring R-star. There are a whole lot of factors that affect R-star, including population growth, including technology, including government debt, right, which would push R-star up. But other factors could push R-star down, such as inequality, such as global financial flows, such as the convenience yield, right? So it could go in either way. And on top of that, we don't know which ones of these factors are permanent or not. So we don't even know if these increases in population growth that we have been seeing are going to be permanent or how long they're going to stick around. Same with technology. I just mentioned I have some optimism and cautious optimism about increasing productivity, but there is substantial uncertainty. So at the end, I think we just don't know. In practical terms, this long-term natural rate of interest is not actually very helpful. It's not what we think of when we're making policy, because many times the short-term R-star, that we don't know either, but it's what we would be concerned with, would capture some of these phenomena, economic phenomena that are happening but may not be permanent, which affect R-star, right? So that's what we're thinking of now. We're thinking about how restrictive is our policy. So the FCIG, for example, how restrictive is our policy, and is that allowing us to fulfill our mandate and to go where we want to go with monetary policy? That's much more helpful, I think, than trying to measure the neutral rate of interest, especially in the long term. Of course, we pay attention to it, but it will be a guess estimate for most of us, I would say.
Thank you. One last question from me, if I could. When we were going through, you were discussing various factors affecting inflation, various measures, and you distinguished shelter or housing-related inflation. There is a lot of discussion in the commentariat about whether, when one's defining a core or a target, do you want to include shelter, the particular ways the U.S. computes shelter inflation? Is it backward-looking? Could you say a bit more about how you think about this issue? How should the Fed be taking shelter inflation into account or not when making its decisions and its forecasts?
Yeah, I mean, we certainly need to take account of shelter inflation because it is a substantial part of the household's budget, right? The typical household's budget, and it is an important part of what determines the ability of households and businesses to spend as well. So we certainly need to take account of it. But as you said, there are various issues. On the one hand, there is a measurement issue that means that there is a delay in the way we properly measure housing inflation. On the other hand, there is also a delay in how quickly housing prices adjust. And that's a separate issue, but both are true. So let me start with the first one, the measurement issue. The CPI goes and asks people and a set of households that turn over every 6 months what the rents are. These rents are used for those who are renters, but also for those who own their households, and then those rents are used to impute owner equivalent rents, okay? So given that people are only turning over every 6 months, you're not really getting, right, in the intermittent period, rents as they're moving along. If we look at Zillow, if we look at CoreLogic, if we look at other rents, they seem to be moving a lot faster. And to give credit to the BLS has used and started this new experimental series on new tenant rents. So they're starting to work on that as well. So that's one reason why rents don't move as quickly as we actually in some of these other measures that we have. The second reason is a real reason. So that's not only measurement, but actually rents are slow moving. And that's mainly because about 2/3 of households rent and have year-long leases. So for a year, they don't see the rents moving, even if new renters are seeing falling prices in housing. That means that the rents will only be adjusted once they either renew the rent or they move to a new unit. And basically, it takes a long time. So it's a full year. Those that renew, we know that landlords are much less likely to adjust rents if they renew somebody than if they take a new renter. So that whole process, we found out, takes a long time. It takes about 2 to 3 years for that to work its way through to the new renters, and then in turn to this housing owner equivalent rent that is given to those who actually own their houses, because you're using these imputed rents. So it's both a measurement issue as well as a real phenomenon. And we know it takes about 2 years. The good news is that the biggest shock was received about in 2022. So we may start to see some progress on that, and we have been seeing some progress, but it's slow moving. And it's slow moving because a lot of these leases are year-long leases, and that's just the nature of the housing market, but we should definitely care about it.
Thank you. Let me open it up to the floor. There's a moving microphone towards the front. There's a standing microphone at the back. If those of you who are able want to walk up to the standing microphone, we'll recognize you. Please identify yourself and your affiliation when asking a question.
Thanks very much, Beat Siegenthaler, Rocco's Capital. Thanks for a great event, also to the Peterson Institute. I have a question on monetary policy strategy. There is this notion that in order to get the perfect soft landing, maybe one needs just 1 or 2 recalibration cuts. Opposed to that, there are those who say, no, like 25 basis points, that kind of doesn't make any sense. So once you start to cut, you really want to have kind of confidence that you'll deliver a series, be able to deliver a series of cuts. So if I could get, it would be great if you could share your thoughts around this, you know, when the time comes, how would you think about getting into it, and how high is the hurdle to actually start? Thank you.
Why don't you take that question?
Did I take that one? Okay. So as you well know, we're data dependent. So I think we continue to pay attention to how the data comes in. And I think we have two-sided risk here. We have the risk of cutting too soon and failing to make continued progress on inflation. On the other hand, we have a risk of not cutting soon enough and then paying undue weight on economic activity and inflation and unemployment. I would say, as I indicated in my speech, that I think if things progress the way we have been seeing, we may be ready to cut later in the year. As to how much we cut, I think that's also a question that we will continue to reassess as more data comes in. But I guess part of the answer to that is that we still see restrictiveness. So obviously it will depend on the circumstances. It's not an answer that we can give today. And it will depend very much whether we're cutting because we see a rapid disinflation or because we see some deterioration in the labor market. So if it's the latter, you may have more reason to maybe do more cuts because policy is still restrictive, right? But if it's the latter reason, it may make sense to go slower. So I cannot give you an answer because I think it will very much depend on how the economic situation evolves.
Thank you. Anyone at the back, Mike?
Thank you. Nick Timmeros of the Wall Street Journal. To follow up on that, Governor Kugler, I mean, you spoke about the need to be forward-looking and to look at the preponderance of data. And just in listening to your speech, you made a number of points that would raise the question, why not cut at your next meeting if the next inflation report is as well behaved as all the reasons you gave would suggest that it would be? What's the benefit of waiting even longer at this point, given all the reasons you laid out?
Thank you so much for your question. I would say, once again, that there are risks on both sides of our mandate, right? So I talk about some of the risks to the downside in terms of economic activity, but I certainly don't discount the risks to the upside on inflation, including housing, for example, right? We have seen that, and I mentioned that in my speech as well, being very persistent. So I still remain a bit concerned about housing prices. I think import prices, as I also mentioned in my speech, is one more reason why we may want to be cautious. There may still be upward pressures. The other one, although I see wage moderation, wages are still higher than productivity. So for us to continue to make progress, we have to see that continued progress on wage moderation, nominal wage moderation, so that gets passed through to lower prices. So there's still some upward risks to inflation, just to be sure, that I'm not discounting, right? I still find credible reasons to keep paying close attention to. And so, again, I cannot tell you where we will be in the next meeting, the September meeting, the November, the December meeting. But as I said, if things do evolve in that direction, then we can think later in the year. But we need to be convinced. We certainly need to be convinced that we're not going to put in danger all the great progress that we've made on inflation, because that I can tell you, I and the rest of the committee is fully committed to getting inflation down to 2%.
Okay, anyone else? A question for the governor? Okay, since we have a few minutes left, I'll ask you one of the questions I didn't ask you yet. You mentioned when talking about the financial conditions index you happen to be looking at, that a stronger dollar, in a sense, counts as part of the tighter financial conditions, I think. On the other hand, we've seen a lot of very large movements of weakened currencies against the dollar, and doesn't seem to have made that much direct impact on the inflation rate, or in reverse in Japan or Germany of their inflation rate going up. So just generally, do you really take into account exchange rate movements as important? And if so, how do you think about the cuts made by the ECB, the Bank of Canada, the Swiss National Bank, and so on? Does that have any effect on your relative decisions about policy?
So let me start first by saying what you, of course, know, which is that we don't make exchange rate policy or dollar policy. We have colleagues in the audience right here who are in charge of that at the Treasury.
Right. This is all assuming you're reacting to.
That's right. So we take that information in. We worry, for example, about import prices, certainly, right? So a stronger dollar helps us to get cheaper imports, right? That's one channel through which it fits into lower inflation that works on the upside. On the other side, it could work because a stronger dollar makes our goods more expensive abroad and imports cheaper, and that affects or decreases real activity, and it decreases GDP by decreasing net imports, so net exports. So I think that's, yes, of course we do. We consider all these factors. I wouldn't say it's a primary factor when we're setting policy, but we certainly consider the potential feedback effects that come in, and again, they could go in different directions, so it's not even that clear. With regards to policy synchronicity, I think the key here is that each central bank and each policymaker is serving their mandate given the conditions they face at home. That is the key, right? And the conditions that we face are different from the conditions the Swiss took their first cut in March, the Swedish in May. In June, we had the Bank of Canada and we had the ECB. And we don't know what's going to happen. Probably, at least what is predicted is that the Bank of England, and you would know this better, is not going to cut next week, but it's going to wait a little bit longer. We're definitely assessing our situation. Our situation is different from the situation in Europe. It's even different from the situation in Canada. It's certainly different from the situation in Switzerland, right? So we're taking in what is right for us and what is right given our domestic conditions to do. And we know that something that is different for the US is that there has been quite a bit of resilience in terms of economic activity, contrary to the rest of the world. That may have to do with the increased productivity, with the increased population growth, right? Many things have helped, which may not have helped either in Europe or in other places, in other parts of the world. So that's true. At the same time, earlier this year, we saw some stubbornness in inflation, and some of it may have been residual seasonality or one-off factors, but we could never be sure, and we want to be reassured that we continue to move in the right path, and that's why we held rates at where we wanted to hold them, which is to give us continued confidence that we will be making progress towards the 2% target. So yes, of course, we consider these second-hand effects, which I view as secondary, right? They're not the primary factors driving certainly our policy stance, but I think what is key is that the conditions are different in different countries and different continents, and that means the policy will not be perfectly synchronized, but it's not atypical. This is kind of within the historical standard, going up to when rates were being hiked back in 22, there was some asynchronicity as well. So I would say that that's natural. But we're moving roughly, in the same direction at the same time. There's some common factors, certainly that some economic conditions that are common. But our structural, the structure of our economies are different. Our labor markets are very different than European labor markets, which means that it may afford us to take a little bit more time.
Terrific. Well, with that, please join me in thanking Governor Adriana Kugler of the Federal Reserve Board.
Thank you.